And I hate to break this to you guys, but on the day that you retire and you start taking money out of your portfolio, long-term averages no longer mean a damn thing. All that stuff that you thought you knew about average rates of return, none of it matters anymore. When people think about 8% averages, what they tend to think is that like it goes up 8% every year. But that's not the way that the stock market works, guys. It goes through these ups and downs over time, right? And if you're 40 years old and we look from here to out here, we're going to be good, right? That's where you can let the long-term averages work for you. But remember, let's say that you're 65 and you retire. What's going to happen if the market is dropping 40 or 50% like we had during the dot-com crash or like we had during the great financial crisis? What's going to happen if you're withdrawing money while the market's going down? What that's going to do is it's going to accelerate the downward spiral on your portfolio. What happens when the market doesn't do when we want it to do? What happened in the year 2000? The market actually went down 10%, right? The traditional financial advisor is going to tell you is, don't worry, 10% dip, not a big deal. Just hang in there. It's going to recover, right? But remember, because you're retired, you also have to withdraw money from your portfolio, right? Now, if you're working with an advisor who follows Dave Ramsey, or if you're listening to Dave Ramsey, he tells you that you can take out 8% per year because that's the market average over time. But look what happens here in a negative year. If the market goes down 10% and you're withdrawing 8%, you just turn that into a total of what? Well, that year, your portfolio lost 18%, right? Your withdrawals coupled with a market downturn that accelerates the downward spiral and can send it into a death spiral that you can make it very hard to recover from. So what happened next year? Did the market recover? Did the market go up? No, actually, in 2001, the market fell again, and it fell even more, right? It fell 14%. Now, here's the deal. Can you just stop withdrawing from your account? No, because you're retired. You're relying on this money, right? You're relying from this income to live on, right? So you're still taking out 8% per year. The market downturn plus your withdrawal rate being too high, you turn it into a 22% decline, right? If you don't understand this shift from the accumulation mindset into the retirement income mindset or the distribution mindset. And if you're doing this right here, like, hey, the market averages 8% per year, that means I can take out 8% without even dipping into my portfolio. You're going to be sadly mistaken, because if you would have retired with $1 million, a couple years later, your portfolio is down to $600,000. And what do you do at that point? Do you just start all out panicking, right? Do you quit retirement and do you go back to work? So what I show people how to do is to remove this uncertainty and to remove this market risk from their portfolio. What we need to do is to protect this money, preserve this money, and turn it into guaranteed income streams that will remove the market risk and will function like Social Security. Because what is Social Security? Social Security is a lifetime income annuity, right?